Most people spend their entire working lives chasing a bigger paycheck. The thinking goes, earn more, save more, retire rich. Simple, logical, and almost completely wrong. Because wealth isn't really about how much you earn. It's about understanding a small set of rules that govern money the way gravity governs falling objects. You can ignore these rules. People do it every day. But the rules don't ignore you. Today, I'm going to walk you through 5 financial laws. Not tips, not hacks. Laws, the kind that compound quietly in your favor when you understand them, and just as quietly work against you when you don't. Most of this won't be taught in school. Almost none of it will be mentioned in the conversations your parents had about money. But once you see these principles clearly, you'll understand why some people with ordinary incomes end up wealthy, while others who earn fortunes end up with nothing. Let's get into it. The first law is about time. More specifically, it's about compounding and why human beings are spectacularly bad at understanding it. Our brains think in straight lines. You save $100 a month for 10 years. You expect to have roughly $12,000, maybe a little more with some interest on top. That's arithmetic thinking, and it's the financial equivalent of being colorblind in a world built on color, because compounding doesn't move in a straight line. It accelerates, slowly at first, so slowly that most people give up before anything interesting happens. Then faster. Then explosively. There's a useful tool called the Rule of 72. Divide 72 by your annual return, and you get the approximate number of years it takes for your money to double. At an 8% average return, your money doubles roughly every 9 years. 1 doubling in 9 years sounds modest. 2 doublings over 18 years, 4 times your money. 3 doublings over 27 years, 8 times your starting point. 4 doublings over 36 years, 16 times your original investment. The critical insight buried in that sequence is this. That last doubling, from 8 times to 16 times, adds as much absolute value as all the previous doublings combined. The math is generating more wealth in that final phase than in the entire prior history of the investment. This effect has a name, the ski jump. For decades, the slope is gradual. The results feel invisible and frustrating. Then, near the end, it launches. Most people never see that launch because they quit too early, or because they keep restarting the clock. They sell when the market drops. They switch to whatever performed well recently. They reset. And every reset means giving up the phase where compounding does its most powerful work. What this means practically, starting 10 years late doesn't cost you 10 years of contributions. It costs you the most important doubling cycle, the final one, where your capital base is largest, and each percentage gain translates to the largest absolute number. Consistency and long holding periods beat chasing superior returns almost every time, because the holding period is the variable you actually control. The second law separates people who build real wealth from people who earn well but never get there. There are 2 fundamentally different kinds of money, and most people never distinguish between them. The first is income. Income is the river. It flows when you work, when you show up, when you produce. Stop working, and the river stops. A promotion widens the river. A second job adds a tributary. But here's the problem with rivers. They tend to be consumed entirely. Lifestyle creep is the most natural, most human thing in the world. Expenses expand to meet income with almost mechanical precision. You can have an enormous river flowing through your financial life and still arrive at retirement with little to show for it. The second kind of money is equity. Equity is the reservoir. It's ownership in something that generates returns without requiring your constant presence. A stake in a profitable business, investment property generating rent, an index fund growing as the companies inside it produce earnings. These assets work while you're asleep, earn while you're on vacation, and compound while you're raising kids and managing your career. The reservoir doesn't drain when you stop showing up. Here is the uncomfortable version of this law. If you are spending everything you earn, regardless of how large that number is, you are not building a reservoir. You are managing a river. The moment the river stops, you have nothing to draw from. And every dollar of spending on consumption is a dollar that never enters the reservoir, which means every compound cycle that dollar could have generated across the next 10, 20, or 30 years is lost permanently. There is a practical metric worth calculating. Take your annual spending and multiply it by 25. That number is your financial independence target, the approximate reservoir size at which a 4% annual withdrawal covers your living costs indefinitely, based on historical market return patterns. This is sometimes called the 4% rule, and while it has its critics and its caveats, it gives you a concrete number to build toward. Most people have never done this calculation. They're building toward retirement without knowing how far away it actually is. The third law is about leverage, and it cuts in both directions with equal force. Leverage is borrowed capital used to amplify your investment power. A mortgage is leverage. Buying stocks on margin in a brokerage account is leverage. Most large real estate and private equity deals are structured around it. And on the way up, leverage looks like genius. If you borrow $900,000 to buy $1 million property with $100,000 in equity, and that property rises to $1.1 million, your equity went from $100,000 to $200,000. 100% return on your actual money while the asset only moved 10%. That's the leverage appeal. The downside of that same structure is mathematically identical, but experientially devastating. A 10% decline in the property's value takes your equity from $100,000 to zero, completely. And the real trap of leverage isn't the math on paper. It's what forced selling does to you in practice. Lenders set collateral requirements. If your asset falls far enough, you receive a margin call or face foreclosure. You are required to add cash immediately or sell the asset right at the moment when everything looks worst, when prices are lowest, when the news is worst. You sell at the bottom and convert what could have been a temporary drawdown into a permanent, unrecoverable loss. Without leverage, you have the option to hold through the downturn. With leverage, that option may no longer be yours. The fourth law is one that almost no one talks about, but it may be the most important of all. The fatal enemy of compounding isn't a bad year. It isn't a market crash. It's zero. Losing everything doesn't set you back to the starting point. It ends the race entirely because there is nothing left to compound, and the mathematics of loss recovery are deeply, structurally unfair. Lose 20% and you need a 25% gain to break even. Lose 50% and you need a 100% gain just to return to where you started. Lose 90% and you need a 900% return to recover. But lose 100% and no future return can save you. There is no remainder for compounding to work on. This is why position sizing, the discipline of deciding how much of your capital to commit to any single idea, is one of the most underappreciated skills in investing. Consider a hypothetical trading system that wins 85% of the time. Excellent odds by any measure. But if you bet your entire portfolio on each trade, the remaining 15% chance of loss guarantees eventual ruin across enough trials. It is a mathematical certainty, not a possibility. Survival is not a defensive luxury you sacrifice for higher returns. Survival is the core requirement for compound interest to function. You cannot benefit from a recovery you weren't present for. The fifth law is about diversification, and it will challenge something you may have been told about stock picking. When researchers examine the full history of long-term equity returns, one pattern emerges with striking consistency. The majority of total stock market gains come from an extraordinarily small number of companies, roughly 4% of all publicly traded stocks throughout history. The other 96%, averaged out across time, return about as much as treasury bills, or less. Many go bankrupt. Most are mediocre. A handful of companies, the ones that become dominant in their industry for a generation, produce nearly all of the wealth. This creates a structural problem for stock pickers. To win big, you need to own those 4% ahead of time, before the companies have proven themselves, before the growth is priced in, before the narrative is obvious. Professional fund managers with research departments, proprietary data, and decades of pattern recognition routinely fail to identify these winners in advance. Not occasionally, on average and consistently over time. The data on this is not ambiguous. Diversification through low-cost index funds is the rational response to this structural reality. By owning the full market, you guarantee that you hold those 4% of companies that generate outsized returns. You also hold the other 96%, but they are a small drag on a portfolio that includes the companies that genuinely change the world. Concentration makes sense only when you have a genuine edge, deep domain knowledge, operational control, and a competitive advantage you can name and defend. In practice, that edge usually exists in your own business and almost nowhere else. Let's bring these 5 laws into something practical. Before you commit any capital to anything, ask yourself 5 questions. Is this investment built to compound over years, not days? Does it build my reservoir, or does it just pass through my river? What happens if it fails completely? Can I actually survive that loss, or does it destroy my ability to stay in the game? Have I sized this position so that no single event can permanently remove me from the market? And finally, can I explain clearly how this makes money, what my actual advantage is, and what could realistically go wrong? If you cannot answer those 5 questions with confidence, wait. Not indefinitely, but until you genuinely can. The most expensive mistakes in finance don't come from missing an opportunity. They come from taking the wrong one. With capital you couldn't afford to lose, with leverage you didn't fully understand, or with a position size so large that a single bad outcome wiped out everything the compounding had built. The loss is not just the money, it's the time, and there is no way to buy that time back. Real wealth is rarely built in a single bold move. It's built in thousands of quiet decisions not to violate these laws, repeated over decades, until the curve does what compounding curves always do when you give them enough time. It launches. If any part of this changed how you think about money, I'd ask you to subscribe to this channel. And hit the like button. It genuinely helps this content reach people who need it most. Leave a comment below and let me know which of these 5 laws hit the hardest for you, or what question this video raised that you want me to answer next. I read every single comment. I'll see you in the next video.